All right, so the market opened higher. We drifted a little bit, but we're staying pretty high. And it's really interesting to me, right? Because we had some great earnings, right? These software earnings, absolutely phenomenal. They're not really the kind of stocks that lead the market per se, but we got to admit, people like them, particularly the cybersecurity darling CrowdStrike. So that's pretty good. But the overarching narrative today is that the Fed is done with rate hikes and now ready to cut, right? So the revived hopes for a Fed rate cut. This is today. This is what they say is moving this market, which I find to be somewhat intriguing. So remember, of course, the question is, when will the first rate cut happen? Now, right now, again, we see it still officially in May of next year. But something interesting is happening if you look closely with this March data. Let's zero in on March, because a month ago, there was less than a 14% chance of a rate cut in March. A week ago, it was a 27% chance. Yesterday, it was a 35% chance. And guess what? Today, the street is saying there's a 46% chance we'll see the first rate cut in March. Now, here's what's really interesting about that. I mean, it sounds groovy. You know, the Fed's out of the way. We're cutting. But this new conventional wisdom is counterintuitive. I mean, we know what irks Jay Powell. We know that he doesn't like market rallies. Stock market and bond market, both moving big time. Doesn't like higher consumer confidence. We had a pretty strong consumer confidence number yesterday, vis-a-vis expectations and where it's been recently. Consumer spending this last weekend was much better than everyone had thought it would be. Positive economic surprises. So these things Powell doesn't like, and yet these are what we've been getting. Also, speaking of these higher or surprising economic reports, we had third quarter GDP revised. I know it's backward looking. Here's what's really compelling about it to me. These are the things that stood out. This is what you're going to read about, and some people will automatically think, well, that could spook the Fed. I think the personal consumption number is intriguing. That's 2/3 of the economy, actually a lot lower than what they initially thought it was. Non-residential structures, maybe this is some of the government spending, huge, 6.9 from 1.6. And residential almost double what we thought it was before. So this is maybe the kind of flow of cash that won't spook the Fed. Maybe not. I will point out, though, with all of this talk about the Fed cutting next year and everyone kind of getting excited, we talked yesterday about all these firms that are upping their targets for next year. There is one firm that's kind of putting cold water on this, right? This is from BCA Research. They're saying not only could we see earnings fall between 5 and 15% next year, but this is their look for the next year. 3,300, that's what they see on the potential downside for the stock market. Wow, that is absolutely mind-boggling stuff. All right, folks, let's start. I want to bring in now our good friend, Don Luskin. He's a TrendMacro Chief Investment Officer. Don, first of all, I feel like, Bill Ackman, he's betting big on the first quarter. You know what? I think Don's picture is frozen right now. In the meantime, as we try to get that up, Bill Ackman, he's betting big on a first quarter rate cut. So here's the thing. Once Bill Ackman's on board, it feels like everyone's on board. I know that, of course, that Don Luskin is on board. Can we bring in Cameron? We've got Cameron Dawson in studio. So why don't we just bring in Cameron? Hey. Thank you for being here. In case of emergency, bring in Cameron Dawson. All right. Bill Ackman saying there's going to be a rate cut in the first quarter. He's betting big on it. Wall Street's jumped on the bandwagon. Where are you on this?
I think we have to ask under what conditions. We know that the Fed has signaled a willingness to do a little bit of an insurance cut, but that's 25, 50 basis points. Right. That's very different than the 120 basis points that the bond market is pricing in. That 120 basis points, if they deliver it, it likely is under more recessionary type of conditions.
But also, if they go March, I mean, it wasn't long ago we were talking June, now May. And if they go March, doesn't that also hint at an emergency?
Possibly not. They've been talking about this idea that if inflation falls,
right,
it gives them room to ease policy. The question is, if they ease policy, could that actually spark inflation to reaccelerate? Could you see the dollar weaken? Could you see commodity prices move higher? And importantly, those financial conditions, markets going up, right, that could spur a big rally. And is that something the Fed doesn't want to see?
Right. And I had a list of the things that the Fed apparently doesn't want to see. Don's with us now, so all three of us will do this together. Don, let's start with this notion that there's going to be a rate cut. I think you agree with that. The question, though, is, listen, Deutsche Bank says yesterday that there could be a rate cut, there could be a recession. They still see the market going higher. You see a rate cut?
Of course, there's going to be a rate cut. It was just a couple of weeks ago that futures curve you were showing was saying it was all the way out in September. Yeah, right. So we're going to have to endure almost an entire year without a rate cut. And as you say, now it's May. I think it's going to be March. Mm-hmm. So, I think I anchor the dovish consensus here. In 2 weeks, we're going to get another CPI number. We're going to get that just before the Fed announcement comes out. And it's going to be the second month in a row with absolutely zero inflation. Already, the Fed can look at that last GDP quarter that you were examining, where you have almost 5% real GDP growth, a quarter during which its preferred inflation measure, core PCE inflation, was only 2.3%, and their target's 2%, and that was against the background of scorching growth. It's time for them to cut. Their job is done, and the real issue is the one that you and Cameron were discussing. When they do cut, will the market breathe a big sigh of relief and say, oh my God, they're late, but they're doing the right thing? Or will the market panic? And of course, it depends on what the path of words that comes from Jay Powell is.
So let me jump in here for a moment, because this all feels like, listen, Jay Powell maybe has pulled it off. Maybe he's going to get this soft landing. But of course, we know there's a thin line between a soft landing and recession, right? And recessions don't really bode well for the stock market. I've got a chart going back a pretty long ways to the 1950s, and it shows all of the recessions. And what we have there associated with these recessions are the market. Every one of these are recessions, and every one of these times that the market went down, Cameron. So I want to just get your thoughts. So, Deutsche Bank is saying, okay, either they say we're going to have a recession, but they still see 5,100 next year. Mm-hmm. So do you grin and bear it? Can we deal with a shallow recession? Or is this the wild card now? Is this the new wild card for 2024?
If we have a recession, what does that mean for the earnings forecast of 12% growth next year that consensus is? And if you go back to that BCA point, they say in a normal recession, earnings actually decline 5 to 15%. So if we have a recession, that means then we likely have far too high earnings forecasts. That's when you ask the question, can the market really shrug that off? We've seen the market shrug off rate cuts as not being a problem, 95, 98, 2019, but those were all times that we didn't have a recession, so earnings weren't cut.
So, Don, last time we spoke, you were the last couple times we spoke, as a matter of fact, you were somewhat pessimistic, for lack of a better word. Where do you see the stock market against all of this?
Well, I'm very optimistic on the stock market. I think that 12% earnings number that Cameron referenced is, I think that's right. I think that's real. I think that's sustainable. I think that's probably sustainable for the next 2 years. However, the Fed is going to cut early. It's going to surprise people. There's going to be a whiff of deflation when they do. And just that word, and the Fed cutting, when that D word, deflation, is out there on Fox Business and CNBC and the Wall Street Journal, that's probably going to drive a correction in stocks without a recession. Go back and take a closer look at that chart you just showed of the stock market. Sure, there are bear markets in recessions. There are also bear markets when there aren't recessions. Like, how about just 2022? We had a 25% bear market and no recession. That could be what we're facing in the first half of next year. Right. Still no recession, but if there's a deflation scare, we could still have a bear market. So that's what I'm worried about.
All right, so let's talk about how to invest in this then, Cameron. I'll get your point of view. You're my Miss High Quality girl or woman. I don't want to offend anyone. So the same firm that says 3,300, they also say, you know what, quality, as much as people come on TV and say they like quality, is actually overbought. They're saying if you look at companies with strong balance sheet relative to the last 35 years to 10 years, look at these numbers, right? High returns, big margins. These are significantly above their standard deviation. They're saying these are so expensive right now. Is this the right place to hide out in high quality names?
Well, one of the things we've always talked about with quality is that valuation discipline is important. There are expensive quality names, but just today we were going through some opportunities for next year. We found names that check our quality boxes that are trading near 6-7 times earnings, that are near their 2020 COVID lows.
Can you give me one?
Well, I can't yet.
Okay.
But we're looking in places like healthcare, places like staples, even utilities, areas that have been left behind. I think that we have to broaden our outlook of where we can find opportunities in this market outside of that small subset of just the leading tech names.
Right. Well, again, strong balance sheet, check. Consistent returns, check. Healthy margins, check. The only problem is that historically they've never been this expensive, or rarely, and maybe that's a trap at this point, right?
Well, I think that's where we have to be very careful and disciplined, because if we just chase into things and ignore valuation, that's the lesson we learned really hard in 2022. A lot of high quality names, tech names, had led the market, but they underperformed wildly over the course of that year just because of valuation.
All right. Cameron, great stuff. Don, thank you so much, both of you. Fantastic way to start the show. We really appreciate it.